Hi, everyone. I'm Rick Bensignor. Today is Tuesday, April 11th, and welcome to this week's In the No Trader show. The lesson of the week: if you're not regularly losing some money, you're not really in the game. That's what we're going to talk about. Before we do that, let me remind you of what we have at In the No Trader, the different products. There are three. We have a weekly ETF Tactical Trader Report that comes out generally on Thursday evenings. It goes through everything going on in the macro investing environment. So we look at the fixed income markets, we'll look at the US dollar, gold, and then we will hone in on the specifics of the S&P, what I'm seeing both short-term and medium-term, to give you the proper backdrop for what I'm expecting going forward. I then each week give you a brand new ETF idea that can be anywhere in nature from a few week position to something that could be multi months. All depends upon what I see and what I think is the best way of playing a particular instrument. And then, of course, I will update, review, and change anything necessary on open trade positions that we have until we close them out. So you get fresh charts every week of everything that we have on and why I'm playing for the levels I am, whether they are targets or stop outs. Again, that comes out weekly. Then we have a monthly 7-Eleven report. I call it 7-Eleven because I choose no more than 7 of 11 SPDR macro ETF sectors in order to, of the 11, I choose no more than 7 with the goal of outperforming the S&P. This is pure relative performance. This aims to outperform the S&P in an up year, aims to outperform the S&P in a down year. So, for instance, last year, the S&P was down almost 20%. We outperformed by just over 6% last year, which is a significant difference than losing the 19% or so. You would have lost 13%. And if you say to yourself, well, Rick, you still lost 13%. Yeah, this is not a hedge fund. This is not looking to make money no matter what. This is an instrument and a report that should help you determine that being in SPDRs may not be the best way of playing the S&P to get the S&P exposure. So it's not like we just outperformed in 2022. In March of this past month, March, as of March 31st, we outperformed in March by 1.81% for the month of March, getting us exactly even on the year. We had a tough January, like most portfolio managers did, because January reversed everything that had been working in 2022. But here's the real kicker. We started this report 32 months ago, so a little over 2.5 years. In that time, we have outperformed the S&P by 12.77% in this 7-Eleven report. So if you followed the recommendations and chose to do the allocations of those 7 sectors as I recommended, you would be ahead of the S&P by 12.77%. So on a theoretical $100,000 account, you have $12,770 more dollars than you would if you had just bought SPDRs since August of 2020. Think about that, what you could do with an extra $12,770 by subscribing to this once a month report and simply allocating as instructed. It's super simple. You're never more in 7 funds than in 7 funds at any one time. We are always 100% invested. We raise no cash. We try to replicate almost essentially, let's say, what a traditional mutual fund active portfolio manager would do, who has a benchmark to the S&P, who's trying to beat it. But we use the 11 sectors as our universe. What are the sector ETFs like XLK, XLP? XLRE, XLU, XLV, XLB. These are, right, there are 11 sectors. We choose to be in no more than 7 at any given time. And we're basically cleaning house on the S&P to be up 12.77% in 32 months, averages about 40 basis points a month of outperformance. And again, this is not being in high beta names. This is not simply having exposure to FANG. This is being in generally, let's say in round numbers, 75% of the S&P every month. It's just knowing how to avoid the underperforming sectors. And clearly, that's what we do successfully over time. So if you have money in spiders, if you are an individual investor and you have money in passive indexes, if you are a financial advisor and you have your clients in these passive indexes, then I highly recommend you check out our 7-Eleven report. Like everything else I do and publish, you have a 7-day free trial. So if you go to inthenotrader.com and sign up for either of these 2 reports or both combined, we give you a super discount. If you subscribe to both, you have 7 days before we charge your credit card, and you have all that time to look through every report we've written. So you have access through your own login to our website of every report. The third product that I have is individual coaching services. Many of you have taken advantage of this, and my calendar gets more and more booked up by those who are hiring me to coach them. If you are struggling in making money, if you find yourself, you're constantly kind of doing the wrong thing at the wrong time, if your process isn't working, I will help coach you. And in my coaching, you are getting over 40 years of my Wall Street experience at playing this game at a very high level. So I did have some BS jobs on Wall Street, as most of you know. I traded in the commodity pits for 12 years before I ever went to Morgan Stanley. I was chief market strategist at Morgan Stanley for many years. I've been chief strategist at several other firms too, and head of cross-asset trading strategy at Wells Fargo. I designed Bloomberg's whole charting system and was head of all of commodities, futures, and technical analysis at Bloomberg. I was the first to teach behavioral finance theory at NYU. So I've got a very significant background. And of course, I consult to some of the most continuously successful funds on the street every day. So you get quite a bit when you get me to coach you. This is somebody who has put in their time and has success playing this game. So that's what I wanted to say about our products. You can subscribe to my In the Know Trader YouTube channel. Go to youtube.com/InTheKnowTrader. Click on the subscribe button, and then every time I put up a video, when you log into YouTube, it'll be on your homepage. Also, follow me on Twitter. My handle is @InTheKnowTrader. So let's talk about the lesson of the week. And you may look at this and say, well, wait a minute, why should I be losing money regularly? And the answer is, it's all part of the game. If anybody tells you, and I got to, you know how frequently I talk about the BS that we see on social media sites about people's success, and 85% of the time our trades make money. That it's all BS. There are very, very few people out there who it's even worth getting into their programs. The newest thing now are AI bots. It's BS, and you're either going to understand that the easy way or the hard way. The hard way is subscribing to some of these nonsense places from people who have absolutely no background, no understanding of the game, and they're just collecting, and amongst other things, collecting your emails, phone numbers, names, and then just selling them also as lists elsewhere. It's a very successful racket for many people out there. And all I can do is caution you about going and spending money on these ads that look and sound too good to be true, because, as you know, there are no free lunches and nothing is as good as it sounds out there, unless you have somebody who you trust, who has a verified track record, who posts their trades like I do. Every 7-Eleven trade from day one is in every issue. You can see the exact month-by-month progress of our P&L, and there's nothing to hide. So let's focus here on, if you're not regularly losing money, you're not really in the game. The point here is several. One, you need to accept losses as a very necessary part of this game. And if you can't deal with losses, then you probably should simply be a long-term investor and do nothing in the medium or shorter term timeframes, because the game of playing the markets includes taking losses. And you've got to learn risk management. You've got to know when the thesis that got you into an idea is no longer valid. And if it's no longer valid, there is no reason to be in that trade any longer, or that investment. So it's something you should constantly do, is check in on, why do I own stock XYZ? Why do I still have so ETF in my portfolio? If the reason you got in is no longer valid, you should take your loss and move on, and take that money and put it into something that has a much better chance of making you money. Don't forget also that if you're doing this in a taxable account, taking losses is not a bad thing, because you can offset them against gains. So it's not a terrible thing. So many people are wired not to take losses, and losses can actually be valuable and helpful, and help you realize also that if somebody has kind of conned you into thinking that this game is just win after win after win, it's not realistic. You need to deal with losses and have losses in order to be able to approach the markets and understand that there are gains and losses, and hopefully the gains well outpace the losses over time. But if you're holding on to stuff, you buy a stock at 60 and it stops trading 15, what are you doing? Think about it. What are you doing? You're holding on to, hopefully one day, maybe 5 years down the road, get back to $60 to sell it out. And then probably when you sell it out, it's going to go higher anyway. There's a point, and I can't tell you what that level is, because it's different for each stock, and it's different. There is no blanket rule on, take a 5% loss and walk away. It all depends on the stock, the beta, how much volatility does it have. But I wholeheartedly believe in stops. There are people out there who say stops are just ways for your brokers and the dealers on the street to make money. They're so wrong. And you need to know how to put in stops at the right places, so that you're not getting stopped out just to see your stock turn right around and, let's say, head higher. But to take an investment or a trade and start losing big money on it is just silly. And if you're not getting out because somebody once told you stops are for suckers, they're just dead wrong. And it means that they themselves have never figured out how to do it the right way. What else can I tell you about this? I think number two here is that you need to play for meaningful stakes. So if you've got a theoretical $100,000 account, to buy $500 worth of a stock is kind of senseless. It's not going to do anything for you. It's not meaningful enough. And if you don't believe enough in the idea in the first place that you're only putting in half of 1% worth, you're you're hurting yourself in the long run. You want to play for stakes that are meaningful enough that you actually pay attention to your trades, so that you don't all of a sudden one day look and say, oh yeah, I bought that 3 years ago and I haven't looked at it since, and now oh gee, I'm down 80% on that trade. That's not what you want. You want to be paying attention enough. You want to have enough money in so that you're paying attention to it, so that I'm not saying you have to watch every day or every week, but you don't want to have, if you're trading, you need to be on top of your account. If you're investing, you certainly want to look multiple times a year at what you've got on. I'm not saying that you should be like jiggling your portfolio constantly if you're a long-term investor, but you want to make sure that you've put enough money into something that it keeps you interested, and you're kind of watching it, whether you watch it for 3 months or you watch it for 3 years or you watch it for 20 years. It needs to be meaningful enough. So I have some general guidelines I can share with you, which I would say on a general stock or ETF, on a theoretical, again, let's say $100,000 account, you'd put in 3 to 5%, but no more than that in any one name, because then that gives you kind of 20 to 30 names to put in a portfolio. And frankly, if you have more than 30 names in a portfolio, you might as well just be long the S&P. There's a point to which you diversify so much that you're hardly going to have a different return than what your kind of those stocks are tagged to. And if you're heavy, let's say in technology and the bulk of your 30 names are in tech, so then just buy XLK instead, the technology ETF, or SMH if you're very heavy in semis. To me, more than 25, 30 stocks is silly to have on. You might as well just invest in the market. The likelihood of you outperforming over time is not high. So generally, I'd say 3 to 5% of your portfolio can go into any one name. That's meaningful enough that you're going to pay attention to it. If you're trading options, generally, I'm going to keep that more to a 2% exposure, not because I want to see you have 50 options on, because you'd never be able to manage 50 options. Even 20 options is too many generally to be on top of. But because they're leveraged, the 2% risk factor is a smart move, because again, depending upon if you're long options or short options, your losses can end up being greater than what you originally intended. If you buy options, it's a different story. You max out loss-wise at what you paid for the option. So if you lose 100% of the option, and you kept it to 2% of your portfolio, the premium that you paid, then you're not going to lose more than 2%. If you're selling options and you sell 2% worth, of course, you can lose more than that. So you have to, anytime you are selling options, whether they're calls or puts, you need to pay much more close attention to what's going on in those names. But those are kind of the general guidelines I would stick with. So I don't want to belabor this idea. We can keep this week's video, fairly short in the scheme of things, but think about that. Losses are part of the game. I'm not saying you're happy when you lose, but you certainly shouldn't be down in the dumps. It's just part of the game. Nor, when you have a good victory, it's okay to congratulate yourself that you put on a great trade. But beyond that, you shouldn't be walking around feeling like you're king of the universe, because people who fall into that trap generally then bet too much on the next couple of trades because they think they're golden boy or golden girl, and then they tend to lose money, and they think that you're infallible, and the thing is you're not. Some of the greatest investors of all time lose 2 out of 3 trades, but because they know how to manage risk, get out with small losses, they can be way ahead of the game, only winning on 1 of 3 trades. So 1 in 3 in basketball shooting is not good, but 1-3 in baseball. If you're a 333 hitter, you're a darn good hitter. And you don't have to even be 50-50 in stock trading to make money if you know how to manage risk. And so this is all part of understanding that taking losses is something you should do readily. Go, okay, got it wrong. You don't attach emotions to it. You just go, you got it wrong. And the greatest investors get it wrong all the time, but they're smart enough to get out before it turns into a major loss. So hopefully you take something positive from this and it can materially affect how you look at the markets and trade going forward. I'm Rick Benson, and this has been In the Know Trader.